In this short video, I want to highlight 3 risks that every stock market investor should be aware of, but also point out that they shouldn't put you off equity investing, and point out 1 or 2 ways of managing those risks. So it's important to be aware of stock market risk, but equally it's important not to be afraid of it. So, good quote to kick off with. Our CIO, Paul Kavanagh, always remember that risk and return are linked. So yes, there is a trade-off. If you want higher long-term average returns, you are going to have to take some risk, but managed correctly, it's well worth doing. Now, if you play it completely safe, all right, and you could be saying, well, why take risk? Why do I want to take risk? All right, why can't I just stay in cash? Well, here's the problem. All right, if you stay in cash over 25 years at 3 different inflation rates, what could happen to the value of your pound? Now, the rates I've chosen are the Bank of England's current inflation target, 2%, the UK's longer term average since about the 50s of 5%, and we've been there in the past, we're not there now, a fairly heavy 10%. But don't look at that and think, he's making up numbers to make his point. We have been there, it's just we haven't been there recently. So, what would a pound look like after 25 years of 2% inflation? And there's your answer. You've reduced it to just over 60p. Crank the inflation rate up to 5%, and you've reduced it to more like 30p. And were we to see 25 years of 10% inflation, your pound will be worth in real terms, in terms of what it will buy, 7p. And that's pretty bad news. If you're thinking, well, 25 years is kind of a long time to look at things, isn't it? Not really. I'm in my 40s. I could be working until I'm 70 plus these days, living apparently until 90 plus. All right, so actually I need a 25-year horizon. And people who are younger than me need a longer horizon than that when you're thinking about building lifetime wealth. So there it is. Now, if you invest in shares, obviously you are taking more risk. I'm not suggesting you're not, but the returns can be quite eye-opening. Now, this is historic. This is looking in the rear-view mirror. No one's guaranteeing you get these returns in the future. But the Barclays Equity Gilt Study reckons that between 1952 and 2010, your post-inflation return from shares, annual post-inflation return, just under 7%. All right. Now, by itself, that sounds all right, but what do you compare it to? Well, property comes in second, quite a lot further down. Government IOUs come in 3rd place, and cash languishes in 4th place. So you can see that if you can manage risk correctly, there is quite a gulf between your bank account return and the return you could get from an asset class like shares. And by the way, some people looked at this and said, wait a minute, property and shares, is that right? Isn't that gap too big? But remember, the property column is ungeared, no mortgage, but so is the shares column. For those people thinking, yeah, but you could gear up your returns from property, and in a bull market, say like we've seen in the last 15 years, that would crank that annual return up. Yes, it would, but if I margined my share account, I'd crank the returns up in the left-hand column too, and that's, by the way, not something I'd necessarily recommend that you do. So I am comparing, or Barclays are comparing, apples with apples in that sense. Now, what are the risks? All right, to just say you can move from cash to shares without taking on extra risk is wrong. So what are the risks? Price risk is the one a lot of people know about. We'll cover that in just a moment. But don't forget liquidity and default risk. When you're looking for assets, looking for shares, it's those 3 together that matter. And most importantly, how you respond to them. All right, so knowing they're out there is one thing, how you respond is another thing. So price risk, that one most people know about. Shares go down as well as up. Anyone who's invested through one of the more difficult periods for shares will know that already. All right. Long term, share prices tend to rise. That's undoubtedly true. Look at the FTSE, look at the S&P 500. It doesn't matter what index you pick. The long-term picture is a good one, but short-term they can be quite volatile. The question is what you do when they are. Okay. Several ways to measure volatility. I'm not going to cover those in this video, which comes as a relief to some. But if you'd like me to, do email me, editor@killick.com, and I'll go into some quite useful things like standard deviation, beta, and so on. But for now, what are we going to do about it? You can't ignore price risk. What are you going to do about it? Diversify. Don't put all your eggs in one basket. More about that in just a moment. Reinvest dividend income. That tends to smooth, that doesn't eliminate volatility, but it does smooth the path a bit. And invest for the long term. All right, don't bail out. When the market has a difficult time, early 70s, terrible time. Anyone who bailed out probably never went back to shares again. Anyone who stayed invested, on the other hand, got back to break even within a few years and did better than that beyond there. So it's the approach that matters here. Now, diversification is important. the worst thing you can do in a way is pick up a newspaper or a magazine and go, woof, I'm just going to buy one stock, I'll make it a big one, because even the biggest shares in the market hit problems. This is BP, bang, there it goes. Surely the company that's too big to fail, there you go. Share price crashes in half thanks to that deep water disaster, and has struggled to recover ever since. So, you've got to be careful where you invest, but people sometimes say, okay, well, I'm not going to buy, one stock. That'd be a crazy place. That'd be like sort of betting on the horses, if you like. So what's the alternative? Do I need to buy the whole market? No, you don't. I mean, if we look at the whole market over a period from that sort of horrendous bear market I mentioned up to, almost the present day or not far off, all right, then yeah, what we see is quite impressive. £25,000, that's a decent sum today, let alone back then, would have turned into something like 2.2 million. All right, that's ignoring the effect of inflation in Venice. A building society account over the same period, more like 396,000. But that still begs the question, well, does that mean I've got to buy the whole market? No. Diversification is about buying a sufficient number of stocks in the right sectors, geographies, and so on to balance out risk over time. All right. Anyway, leave that point for another video. It's worth bearing in mind. Now, price risk. Quite a few people have at least heard of, but there are two more. Liquidity risk is the risk that you can't get out when you want to, or you can, but at a terrible price. And some assets are less liquid than others. And I'll just leave you in this video with that thought that very small stocks, property, and some funds can suffer this problem. All right, property can look like a great asset. There are some half-decent returns out there, but beyond owning your main home, which isn't an investment, be careful. Because at certain times property can be very difficult and expensive and slow to liquidate. And equally some funds. Some hedge funds and private equity funds won't let you get out once you're in, and some open-ended styles of funds will let you out, but the fund manager's got to go and sell assets to do it, and that can result in some not great prices. So just be careful, be aware of liquidity risk, all right, and just know how to manage it. So don't ever be a forced seller. Don't get yourself in a point where you've got to sell. Try and plan your future cash flows. All right, don't panic sell. Above all, don't join the herd in stampeding out of assets at a really terrible price. And if you're not comfortable with liquidity risk, avoid it. Just don't go into assets where you can't pull your money out. Most of the bigger shares, for example, are liquid. You can go in and out more or less when you want to. All right. Although if you don't do it too often, obviously that increases your returns over time. Now, that's the second risk. There is another one, default risk, worth flagging. That is simply the risk that your capital isn't returned due to something called a credit event. That's a flash-sounding phrase, just to cover the idea that basically you may not get your money back. So, for example, a company that issues an IOU may not be able to pay back that IOU. Sometimes companies go bust, and that leaves you having invested your capital and you don't get it back. All right. It's a function of both the issuer and the security. Just bear in mind that some quite well-rated issuers, companies, can issue quite risky securities. And there are agencies out there that specialise in kind of monitoring this and grading it. But what I'm saying to you is just bear in mind there is that third source of risk. Most important thing is how you mitigate it. Diversification will help. And for those people who can and want to do it, monitoring red flags. Now, I mentioned of a couple of videos at the end of this video, but knowing the danger signs when you're looking at shares or retail bonds, for example, can help because it can get you out before the real trouble starts. And there on the right-hand side, a reminder that really, chasing yield can be a mistake. Don't go looking when interest rates are low for that high annual income return until you understand the other risks that come with it. All right, and default risk might be one of them. Okay. So where else can you go for information? That's a fairly quick tour. What I'm saying is there are three sources of risk for equity market investors in particular. Where can you go for more information? I've got some videos out there. If you want to hear more about how powerful long-term compounding can be, which is why I recommend it, go for that video. And the importance of reinvesting dividend income, video number 2 there. The strategy to save or to invest of long-term investing, some tips in there. Why and how to save is similar. All right, so those are good for setting the scene on the right approach to wealth building. And investing red flags is for those people who want to go and actually get a bit more detail on how to spot a company that might be heading into trouble. All right, could be proposing that sort of default risk that I mentioned. Any questions on that? That was a fairly quick tour of 3 risks, editor@killick.com.